Financial market risk refers to the potential for losses or adverse effects on investment portfolios or financial assets due to fluctuations in the overall market conditions. It encompasses the uncertainty and volatility associated with various economic factors, such as interest rates, exchange rates, inflation, geopolitical events, and market sentiment. Understanding and managing market risk is crucial for investors, financial institutions, and businesses to protect their capital and make informed investment decisions. There are several types of market risk that investors and financial institutions typically encounter. Systematic risk. This type of risk arises from factors that affect the entire market, such as macroeconomic events or systemic shocks. Systematic risk cannot be eliminated through diversification and includes risks like recession, political instability, and natural disasters. Examples of systematic risk include market crashes, economic recessions, or interest rate changes by central banks. Interest rate risk. Interest rate risk refers to the impact of changes in interest rates on the value of financial instruments. It affects fixed income investments like bonds and loans. When interest rates rise, the value of existing fixed-rate bonds decreases, leading to potential losses for bondholders. Conversely, falling interest rates can increase the value of fixed-rate bonds. Market volatility. Volatility represents the degree of price fluctuations in the market. Higher volatility implies larger price swings, indicating greater uncertainty and risk. Market volatility can be driven by various factors, including economic indicators, corporate earnings reports, geopolitical events, and investor sentiment. Investors must be aware of and manage volatility as it can impact the value of their portfolios. Currency risk. Currency risk, also known as exchange rate risk, arises from fluctuations in foreign exchange rates. It affects investments or transactions involving different currencies. Changes in exchange rates can significantly impact the value of international investments, affecting the returns for investors and companies engaged in international trade. Liquidity risk. Liquidity risk refers to the possibility of not being able to buy or sell assets quickly without significantly impacting their prices. It occurs when there is insufficient market depth or when investors rush to exit positions simultaneously. Liquidity risk can lead to increased transaction costs, wider bid-ask spreads, and potentially lower returns. Counterparty risk. Counterparty risk refers to the possibility that the other party in a financial transaction may default on its obligations. It is particularly relevant in over-the-counter, OTC, derivatives and credit default swaps. If a counterparty fails to fulfill its contractual obligations, it can result in financial losses and impact the stability of the overall financial system. To manage market risk, investors and financial institutions employ various strategies and tools. These may include diversification, hedging through derivative instruments, setting risk limits, stress testing, and conducting thorough fundamental and technical analysis. Risk management practices aim to identify, assess, and mitigate potential risks, enabling investors to make informed decisions and minimize the impact of adverse market conditions on their portfolios. Example: market risk management at J.P. Morgan Chase. J.P. Morgan Chase, one of the largest financial institutions globally, places significant emphasis on market risk management to safeguard its assets and maintain stability in volatile market conditions. The bank utilizes a comprehensive framework that encompasses various strategies, tools, and risk management practices to identify, measure, monitor, and mitigate market risks effectively. Here are some key aspects of J.P. Morgan Chase's market risk management approach. Risk governance. J.P. Morgan Chase has a robust risk governance structure that includes dedicated risk management committees and a clear delineation of responsibilities. The board of directors oversees risk management, and senior executives are responsible for setting risk appetite and ensuring compliance with regulations and internal policies. Risk measurement. The bank employs sophisticated risk measurement models and techniques to assess market risks accurately. These models include value at risk, VAR, stress testing, scenario analysis, and sensitivity analysis. These measures enable J.P. Morgan Chase to quantify potential losses under different market scenarios and assess the impact of adverse events. Diversification and portfolio management. J.P. Morgan Chase emphasizes diversification of its investment portfolio to mitigate concentration risk and reduce exposure to specific asset classes or sectors. The bank aims to maintain a well-balanced portfolio by considering various factors such as asset class, industry, geographic location, and issuer credit quality. Hedging and derivatives. J.P. Morgan Chase utilizes hedging strategies and derivative instruments to manage market risks effectively. Derivatives such as futures, options, and swaps are used to hedge against potential losses and fluctuations in interest rates, foreign exchange rates, and commodity prices. These tools help the bank protect its positions and limit downside risk. Risk limits and controls. J.P. Morgan Chase sets risk limits at both the individual and portfolio levels to control exposure to market risks. These limits define the maximum acceptable levels of risk for specific assets, trading activities, and market positions. The bank's risk management systems provide real-time monitoring and reporting of risk exposures, enabling timely actions to stay within the defined limits. Stress testing and scenario analysis. J.P. Morgan Chase conducts comprehensive stress testing and scenario analysis to assess the resilience of its portfolio under adverse market conditions. These tests simulate extreme events, market shocks, and macroeconomic scenarios to evaluate the potential impact on the bank's capital, liquidity, and profitability. The results help inform risk management decisions and enhance the bank's preparedness for different market scenarios. Regulatory compliance. J.P. Morgan Chase operates in accordance with regulatory requirements and guidelines set by regulatory bodies such as the Office of the Comptroller of the Currency, OCC, and the Federal Reserve. The bank ensures compliance with regulations related to capital adequacy, risk reporting, stress testing, and market risk management. Market risk management is an integral part of J.P. Morgan Chase's overall risk management framework. By adopting a proactive and comprehensive approach, the bank aims to protect its financial position, maintain the confidence of its stakeholders, and navigate market uncertainties effectively. Overall, market risk is an inherent part of financial markets, and understanding and managing it is vital for investors, institutions, and businesses to navigate uncertainties and protect their financial interests.